That much anticipated employment report that we got this morning may be opening the door for those rate cuts that everybody's looking for. It's Friday, September the 5th, and this is Markets with Megan. If you like this podcast, please subscribe. You can hit that alarm bell. Also, share it with friends, family, or colleagues. And we're here today to go over the economic data that we receive, and our goal here is to break it down. What does it mean for the economy? What does it mean for interest rates as we go forward? And this morning, we received that much anticipated employment report for the month of August. This is the last employment report that the Fed will get before they meet in a couple weeks here. And the data that we got suggests that they will likely cut interest rates by 25 basis points at their next meeting. Now, let's dig down into the details. The U.S. economy added only 22,000 jobs for the month of August. That brings the 12-month moving sum of jobs to the lowest that we've seen since 2021. The unemployment rate also rose from 4.2 to 4.3%. That's the highest unemployment rate that we've seen in 4 years. So this is giving the Fed that flexibility. When we dig a little bit deeper and look at where the jobs have been lost, it's been in those goods producing jobs, and that's been reflected in the ISM manufacturing reports. We're seeing jobs also lost in the government side. We know that that's been a phenomenon going on this year. Professional and business services, temporary workers, which have been weak for many, many months and tend to be a leading indicator for the labor market as a whole. Where we saw increases, though, which is contrary to what we saw in the ISM services report, is that private service providing jobs actually increased pretty significantly by 63,000 jobs. We also saw education and healthcare, as well as leisure and hospitality. So people are still spending on that experience, and you're seeing that in the labor market. We also saw a big increase in the labor force. That increased about 436,000 jobs. And so we are seeing those cracks widen here in the economy. When you look at the underemployment rate, that rose to 8.1% from 7.9%, and that's also the highest we've seen since 2021. Remember that underemployment rate is those Americans that are working working part-time, but they would prefer to work full-time, typically for economic reasons. Now, this weakness in the report does carry over to some of the other indicators that we got this week. We got the JOLTS report, which gives us the job openings or the job postings in the economy. And for the first time since basically the pandemic, we saw that job postings dipped below those unemployed. And that means that the labor market is coming back into a better balance. And there is some potentially downside to the labor market if this continues on that way. Now, from an earnings perspective, there was no major surprise there. We got the average hourly earnings growing on a year-over-year basis at 3.7%. The expectation was for 3.8%, so we're getting a little bit of slowing there. But at 3.7%, that still is a little high if the Fed wants to get down to a 2% inflation target. That's all we have today. We think that the result of this is going to be that the Fed cuts interest rates by 25 basis points at their meeting. We still will get next week all of the inflation data the Fed's going to want to see, or at least most of it, before they do meet to see what's going on with inflation and is the tariff spillover going into some of this data. We think, regardless of what happens, that 25 basis points is likely to happen, but there is some chance that people are starting to price in that we may see a 50 basis point rate cut. At this time, we do not think that. In fact, we've always been in the camp that we think the Fed could probably have a couple more months of waiting and seeing. This labor market data obviously gives them the flexibility to go ahead with that rate cut, but we are concerned that inflation should not be ignored and that the Fed can't forget they have a dual mandate, and what's ever moving the farthest away from their targets is what they want to focus on. Unemployment obviously is a concern, but so is inflation. So that statement that they carry on and any other Fed comments that we get will be heavily scrutinized, as well as what the future interest rate path may be. Thank you very much. And if you want to see a history of our podcast, you can go to marketswithmegan.fm. Thanks.